Welcome to Talk Tickers. Today we are digging into Disney's Q4 2025 earnings. And wow, what a report. You have the company telling one story, a story of great progress. But then you have the market, which reacted, well, let's just say it told a very different story. All right, so here's how we're going to break it all down. First, we'll look at that really rough day for the stock. Then we'll dive into the mixed results, the good, the bad, and the ugly. After that, we'll cover the story management's telling versus the one the market actually heard. And we'll wrap it all up with our take in the next call. So let's jump right in. Picture this. It's the morning of November 13th, 2025. Disney drops their earnings report before the opening bell, and Wall Street is ready to react. And whoa, here's that reaction. A nearly 8% drop in one day. We're talking huge volume, billions of dollars in value just gone. This wasn't a little pullback, folks. This was the market screaming that it did not like what it saw. So the big question is, why? Why such a brutal sell-off? Well, the answer really starts when you look at the headline numbers, because it's not a simple story. It's almost like we're looking at two different companies inside of one, a real tale of two Disneys, each one pulling in the opposite direction. And here you see it, clear as day. This is that classic split decision that really gets investors nervous. The bottom line, adjusted earnings per share, they actually beat what analysts were expecting. That's good, right? But, and it's a big but, the top line, the total revenue, came in short. And in this market, you miss on revenue, you signal slowing growth. And that's the number everyone's going to focus on. Okay, now, if you want to see that split in action, just look at the different parts of the business. The experiences segment, the theme parks, the cruise ships, it had an amazing quarter. Profits up a solid 13%. But then you look over at entertainment, that's the movie studio, the old school TV networks, and oof, a 35% drop in income. It's literally a boom on one side and a total bust on the other. But, amidst all that, here's the one area where management can take a serious victory lap. Their streaming business. Remember when this thing was just a giant cash furnace, losing billions of dollars? Well, look at it now. It's completely flipped the script. From a $4 billion loss a few years ago to generating over $1 billion in profit this year. That is a huge, huge turnaround. So you can imagine, with that big win in their back pocket, management gets on the earnings call feeling pretty good. They're ready to tell this very optimistic story about where they're taking the company next. And that's exactly what CEO Bob Iger did. He basically said, look, this was a great year. His whole message was that their big transformation plan is paying off. That the new Disney, the one powered by streaming and the theme parks, is now the real engine of the company. So their strategy from here is pretty straightforward. It's really a three-part plan. First, keep that streaming momentum going. That means folding Hulu into Disney Plus and finally getting that full ESPN streaming service out the door. Second, just double down on what's working. Pour more money into the parks and cruises. And third, give a lot of that cash back to shareholders. We're talking a 50% dividend hike and a huge $7 billion buyback plan. Okay, so management is painting this rosy picture of the future, right? But that 8% drop tells you the market was completely focused on the here and now. It was basically a massive vote of no confidence. So let's really dig into what had investors so worried. And this is really the heart of the matter. This massive disconnect. Management saying, hey, look at our earnings growth. It's fantastic. But investors, they're looking right past that. They're staring at the parts of the business that are, frankly, decaying. They see that revenue miss, a movie lineup that isn't hitting, and a scary 16% drop in their traditional TV business. That number right there just screams that cord cutting is getting worse fast. So really, it was kind of a perfect storm of concerns that drove that sell-off. You've got the revenue miss making people question demand. You've got the linear TV numbers looking really bad. The movie studio profits are way down. On top of all that, there was this uncertainty around a dispute with YouTube TV, and the whole market just happened to be tanking that day. You put all that together, and yeah, you get a recipe for a disaster. So where does that leave us? On one hand, you've got management's vision of this new, growing Disney. On the other, you have the market shouting that the old Disney is falling apart way too quickly. So, trying to balance those two very different stories, here's our take for the next call. All right, before I give you our rating, let's just quickly define what we mean by market perform. It's a standard term, but it basically means we think the stock is going to perform pretty much in line with the overall market, like the S&P 500. It's a neutral call. We see good things, but we also see some pretty big challenges.
Okay, so our official call, we're initiating coverage on Disney with a market perform rating. Why? Because the stock is caught in this massive tug of war. You have the parks and streaming businesses pulling it higher, but the legacy TV business is just this huge anchor dragging it down. We think it's going to be stuck trading in a range, pretty much going sideways, until one of those forces clearly wins. For next quarter, we're watching two things super closely. Can they keep growing those streaming margins, and can their new movies actually bring people back to theaters?
And really, it all boils down to this one single question. It's the question that's going to define Disney's stock for the next few years. Can the new growth engines, the parks and streaming, spin up fast enough to let the company escape the gravitational pull of its old legacy business? Everything, and I mean everything, for an investor hangs on the answer to that.
And as always, remember, this is not financial advice.